everybody, welcome. We have a number of people logging in, so I am going to give them a minute or so to get in here, and then we're going to jump in and get started. So hope everybody's doing well today. Thanks for being here. I know that if you're on the West Coast, it's late afternoon. If you're in Central Time, it's probably getting close to dinner, and if you are fortunate enough to be on Eastern Time, you might be getting ready to go to bed right now. So hope your day's been good and you've had a good week. But I'm Mike Morawski. Thanks for joining us today. I've been hosting the Smart Money series over the last several months and bringing together some real experts on investing, capital raising, real estate, financial planning, and just having great conversations. So if you're joining us again, welcome. If you're here for the first time, welcome. And I'm glad you're here. So as we go through too, I know that I have the chat enabled. So feel free to throw a hi in the chat right now, or to tell us where you're from so that we can get to know you a little bit. And if anybody has questions throughout the way, throw those in the chat as well, and we'll get those answered as we go along. If you're joining us as a passive investor, looking to place capital more intentionally, we're looking to build more of a meaningful relationship with you. So you're in the right room this afternoon. The good news is we're not going to be selling you anything today. And, maybe somebody's even disappointed that we're not going to sell you anything. But the good news is we're not going to try to sell you anything. We're going to just try and give some education or some perspective from where each of us sits in the market today. I know you won't be disappointed. But we're, as I said, we're not here to sell anything. We're here to bring education to help you make better decisions on your investments in the coming months and on your investment journey as a whole. So with the market shifting quickly again, and I think that every month or every couple months we're seeing some kind of a shift happen. The time to position your investments for tomorrow becomes now. We're living in a time where traditional paths to building wealth, like stocks, savings accounts, and even single-family real estate, are being challenged more and more. I think investors are turning more towards alternative investments, and not necessarily just real estate. But I'd like to say specifically multifamily real estate, but for the simple reason that they want more cash flow, tax advantages, and really build some long-term wealth. We know that alternative investing can really help you do that, especially when you don't have to deal with tenants, trash, and toilets in many situations. But here's the truth. Great deals don't get done without great capital. And great capital doesn't come without trust, relationships, and communication. And so that's what today's about, is we're here to help build trust with you, with us, that you might make smarter decisions moving forward. Today we're going to go beyond surface level conversations. I know I've been on a number of these panels or webinars, and it's just surface level conversation. But today I'm going to ask some hard questions of our panelists, and I'm going to really try to take a deep dive. And the reason for that is, as I said, to build trust with you and us, to communicate effectively before, during, and after deals, right? You want to know that you are putting money with someone that's going to give you that communication skill and fill in any gaps. I want to bring you information that's going to help you scale your investments and develop a mindset that you can operate at a higher level in this space. And to do that, I brought together 4 great experts today that I'm super excited about. I'm joined by Rebecca Iyer, Kurt Marker, aka Captain Kurt, Colin McEvely, and Kevin Cook. And I'm going to let each one of them introduce themselves as we get started here. But each of them brings a unique perspective, from building investor relationships and raising millions in capital to structuring deals, nurturing relationships, and scaling their own portfolios. These aren't just theorists, but they're actually in the trenches doing deals, working with investors, and navigating the same market conditions that all of us are faced with today. We're not dealing with anything different than you'd be dealing with. So my encouragement for you this afternoon is that you would lean in, take some notes. If you're driving, you maybe even want to pull over and take some notes. But to think about how this can apply, or how you can apply what you hear today in the coming months as you look at deploying capital, either traditionally or in alternative investments. Because at the end of the day, the business comes down to one thing: people, relationships, and trust. And if you can master those, you're going to win in any market. I've told people, I've said, I've invested when the market's high, the market's low, a Democrat's in office, a Republican's in office. It doesn't matter. If the deal's right, you can make money. And that's what we're going to share with you today. So let's jump in and get started. As we get started here, I'm going to let ladies go first. So Rebecca, why don't you jump in, introduce yourself, and then we'll pick on somebody else.
Appreciate that. Ladies first. Chivalry's not dead. I love it. Program area. Chief financial strategist at Blue Sky Financial. We're based just north of Austin, Texas. We specialize in retirement planning, specifically with women and entrepreneurs, focusing on tax minimization and income in retirement.
Great. Thanks. Kurt, why don't you go next?
Hi guys, I'm Kurt Marker. I run a real estate development firm. We operate in the industrial space. Previously, we had mobile home parks and small multifamily, developed some townhomes and luxury homes in Vail. So we have a wide range, but we are strictly industrial investors now, as we love the asset class. We've got around 50 investors currently. We're really selective with investors, but we built a great team consisting with just very high level people. And that comes from, we're about 11 years experience now. And prior to coming into real estate investing, I was actually a financial advisor. So we like helping people make money, but I built a great team around me. And right now we're primarily in the Houston market. We've been there 6 years now, and looking at a couple other markets, but we believe in really becoming an expert in an asset class, but also in an area. So if your assets are doing very, very well, which ours are in Houston, why necessarily go to a new market? And you got to build another team of escrow people and builders and insurance brokers and all this. So right now we're heavily investing in Houston, Texas, and looking at a couple other markets, but kind of tiptoeing in there and seeing what the market does. But that's us.
Great. Thanks, Kurt. Thanks for being here today. I appreciate you. Kevin.
Thanks, Mike. Kevin Cook here. I am a stock strategist for a company called Zacks Investment Research. And we basically write newsletters. So I research stocks, pick stocks. You might be wondering what the stock market guy doing here, but I'm going to try and connect a couple of mega trends that I see happening in the AI transformation that's happening in the economy and the reshoring of manufacturing to the US, which is a big deal. So I know a lot of real estate investors who look at different MSAs and the demographics and the job growth and the rent growth and that kind of thing. And so I want to see if I can help you sort out where I see some of the opportunities are in the AI data center build out, the semiconductor chip foundries, and then also automotive and robotics, which is going to become a huge growth area over the next 10 years.
Thanks, Kevin.
Oh,
Appreciate
by the
it.
way, I should explain the goofy picture behind me that you wondered what that was. This is something I had on there a long time ago. I'm going to move out of the way. You can see that's a Caterpillar crane behind me. And this is from a presentation that my favorite company in the world did, NVIDIA. We've owned them since the lows in 22, and we're up like 1,500%. What does Caterpillar have to do with NVIDIA AI? Well, they're big partners, and you're going to see a lot more Caterpillar equipment become automated, robotic, with embedded intelligence.
Interesting. Yeah, it's funny where the world's going. I'm glad Kevin's here today because Kevin will kind of be the contrarian, right? Because I think most of us here really are of the alternative asset mindset, and Kevin comes really from not that he doesn't believe in that, but he really comes from the traditional investing world. So, how about you, Colin? You want to jump in?
Well, I just also want to add to Kevin's point. Caterpillar typically is a leading indicator. Their orders, it's kind of like what's going on in the construction market that summer. So how busy are they? That could be an indication of permits pulled is another leading indicator that we look at. But how my attendance here matters for the audience today is really, so I'm an LP on 15 investments, I think maybe 25 or 26 total, gone full cycle a couple times. I'm really just learning like a lot of us. My background specifically is I've helped raise for 26 projects, a total equity need of 230 million from retail investors. That translates to a lot of conversations, probably 10,000 conversations. And so my goal today is to talk about some of the lessons learned from some of the more sophisticated investors that I have calls with so that I can share that with people on the line. And then my team focuses specifically on manufactured housing communities in California. Our managing director, one of the themes for today is partner with people with lots of experience. Sounds like Kurt has that. My managing director has 45 years of owner operating experience, 25 full cycles, 2,500 acquisitions, specifically in one niche asset class, which is mobile home parks, manufactured housing.
Awesome. And Colin just recently got married, so congratulations for that.
Thank you. She's very patient.
Yeah. Well, great. Well, I'm glad everybody's here. As I said kind of earlier, we're going to have, I got a series of questions. We'll probably get through a couple of them for time's sake. And some questions are specific to you because of what you do in the world, and most questions will be for everybody to answer. So, Rebecca, I want to start with you again. But I think that a lot of times people leave this question to the end, but I want to address it up front. And that is, what are market conditions are you seeing today, and what's investor sentiment around those market conditions?
See, from the conversations I have, I deal direct to consumer. So I'm dealing with families and people who want secure income in retirement, but we're all kind of waiting for a correction. And we're seeing some of the indices really focus on that. If you look at the PE ratio, you look at some of those things coming up, the PE ratio right now is over 42. That's extraordinary. And I don't, you look at what the Mag 7 has done this year, we're down 2.5% just on those. People are starting to feel cautious, which is interesting because we've had 18 years of pretty much up and to the right, but they're starting to look at alternatives and be more open to those things, which I find really exciting. I don't know, not that we're going to talk about politics this evening, I don't know that we're going to have a real correction in this administration. I think administration is exceptional at market manipulation. I'm not going to go any further than that. They're really good at it. So I think for this administration, we're there. I don't know how much more we have in us, but I don't think we're going to see a market correction major during this administration. But people are starting to feel cautious. How long? Everything that goes up is going to correct eventually. Reversion to mean is a thing. So families are starting to pay attention to that, and we're having those conversations directing towards more conservative but alternative assets every week now, which was definitely not the case 3 years ago.
Yeah. I find it interesting that you mentioned that we're starting to feel, cautious. I have kind of felt it in the capital raising world with private investors for the last 2 years. So I actually, at the beginning of this year, actually thought we were maybe going to come out of it a little bit quicker, but it seems like it's more of 25 here. So how about you, Colin?
As it pertains to investor sentiment?
Yeah, market conditions, investor sentiment.
Yeah. Well, I mean, from investor sentiment perspective, when I'm approaching investors, it's how do you talk to an investor that's been burnt? And this is for somebody, I mean, like myself, you mentioned I just got married. We have a nice house, but I want to expand on it. And I'm just thinking, I have 4 projects that are kind of in a dump out of those 15 that I'm an LP on. And I just wonder, it's like, man, I wish that project went full cycle. So when I'm working with investors, I I noticed maybe 2 years ago that people don't really they want more certainty on the back end and the projections and stuff versus they're starting to realize that all these things all these estimates and these back end returns they're just estimates um and I was thinking what if higher preferred returns started to be structured into deals? Would that change the investor mindset? And unfortunately, a lot of the newbie investors they still want this pie in the sky large back end number, when I think a more conservative investor is looking for something more secure right now. And that's why there's this flurry of debt funds. I think 3 years ago there was like 100 different debt funds just in my email inbox. And but as far as market conditions, you also have to understand that, are we in 2011 again, in the sense that we haven't had a bunch of big bank failures, but there's opportunity because a lot of the snakes and the grifters, they're gone. If you look at the amount of wholesalers there were in 2020, I think the number was 80,000. Now there's only 30,000. That's a single family number, but commercial properties, they kind of trail, or commercial multifamily kind of trails the single family market by about 18 months. So I feel like now's the time to maybe put in disrespectful real number offers, just because now's the time that you're going to get it. Whereas two years ago, somebody would look at your offer and they wouldn't even entertain it. Obviously there's situations where people were just blindly investing, but um, that's kind of my feeling is there's a lot of mistakes being made, and we'll talk more about that later.
Yeah, yeah, for sure. Um, yeah, I think pricing has changed a lot, and it's definitely, you're seeing it in the market. I know that we underwrote a deal, just real quick. We underwrote a deal a little over 2 years ago in Dallas, and the deal, when we underwrote it, they were asking 15 million, and I got a call a month ago from the broker who said, "Hey, you could buy this today for 11." So, pricing has changed a lot. So, how about you, Kevin? Where are you seeing market conditions in your world, investor sentiment?
So I've got something practical for you about the data center market versus the semiconductor market. But let me go sort of high level here first, because I'm always asking, how does a mega trend in technology translate into economic growth? And this is not a new ball field for me. In 2017, I wrote a paper called The Technology Supercycle, where I looked at what was happening with technology is deflationary, right? We get more better tools, better, faster, cheaper. And so that's one force in technology. And the other is that Moore's law, where chips shrink, accelerates technology. So there's this big convergence of technology, and we don't see the productivity in the government numbers. You hear about a headline productivity number of 2%, but that didn't seem real to me back in 2017, when I had a smartphone that I could do all kinds of things with. Holding a computer in my hand just made me, I felt like 10 times more productive. So I wrote that thesis in 2017, and it's finally playing out since, whether you like it or not, ChatGPT, that took the world by storm in 2023. It's created a whole revolution because corporations realize they can use these agentic AI tools to streamline their business, to innovate, to have, whether or not they're interested in cutting staff, they can actually make employees more productive by having employees create two, three, six different agents. They can essentially be like they can multiply their productivity by 10x too. So, so what really interests me right now, or one of the areas that I think is most interesting, is the intersection of the stock market, what I do, where I pick stocks like Nvidia, and the real estate market, because of the AI transformation and an American manufacturing renaissance, we're bringing jobs home. So I call it the fifth industrial revolution. Back since the internet, and then the smartphone and cloud and genomics and high-speed bandwidth, that was like the fourth industrial revolution. We're in a new era right now where the power tools that NVIDIA makes for high-speed computing, it's just launching the capabilities of not just corporations, but also science. So we're sort of in this, that's why I call it the fifth industrial revolution, because it's converging all these different technologies to create more innovation and, hopefully more jobs, right? So we've got an explosion of knowledge and efficiency across medicine, energy, materials, engineering, manufacturing, transportation, agriculture, and the sciences. And so how does this become something practical? Well, we've got the big giant companies. Rebecca mentioned the Mag 7. So Microsoft, Amazon, Google, Meta, and I'd even throw Oracle and Tesla in here, what we call the hyperscalers. They spent $500 billion last year to build out this AI infrastructure. They're going to spend over 700 billion this year. And so that's doing a couple of things. It's building data centers, but do data centers actually create jobs? In the short term, they create a lot of construction jobs, and they demand supplier equipment, so big transformers, the hardware for the data center, but they don't create a lot of local permanent jobs. What does, though, is the semiconductor foundries or fabs. Now, and we're seeing those, like Taiwan Semiconductor is building an enormous complex in Phoenix. You've got Micron, which is going to invest tens of billions, and they're building a new foundry in New York. And we're seeing this in different pockets. So those, if you will, we can call them plants. They will create a lot of permanent jobs, because what happens, especially with semiconductors, is because they use specific chemicals and processes, their suppliers like to locate right around them. So, and that's what can create permanent jobs. So it's kind of like the auto industry. So if you look at Hyundai now, Hyundai is just an incredible South Korean company, they make their own cars under their own label, Hyundai, and then Kia, and then also the Genesis luxury brand, sort of like Toyota's Lexus. They've got a large plant in Georgia, and that's what we've seen is the suppliers build around that. And so that creates an ecosystem, and that MSA in Savannah, Georgia becomes a place with growing jobs, growing salaries, and a place where a real estate investor might want to look. So I'm really excited about where this is all converging and how fast it's growing with the kind of spend that we're seeing to build out the AI infrastructure.
Yeah, interesting. I remember, AI is really just it's crazy today how fast that technology changes. I remember 6 years ago watching an interview on 60 Minutes. And during that interview, they were talking about AI being launched and coming to the world. And I thought, boy, this is like watching the Jetsons on Saturday morning. And look where that's at today. So, Kurt, how about you?
Yeah, I mean, Kevin made some great points. So I'll piggyback and just add to that on the real estate side as I start. So Kevin's right. Because I'm an industrial investor, a lot of what we're tracking is e-commerce and manufacturing. Manufacturing is coming heavily back to the States instead of overseas due to the tariffs. What does that do in our market of Houston, as well as we're tracking other markets? Houston is the second largest port, which has grown 40% in the last 3.5 years. Now, that was before Trump took office and created the tariffs. It was already increasing due to a lot of people moving out of California, businesses, Tesla, Chevron, left California. So there's a lot of manufacturing going on, and wherever manufacturing needs to happen, it's typically near ports and then logistically trucked up to Dallas or trucked out to Atlanta. So there needs to be a lot of real estate, warehouses to bring in product from ships, right? So that's one thing. Even though we don't build the 1,000,000 square feet industrial plants, because that's not what we're targeting, we need to track that. So wherever shipping is coming in, an hour, 2, 3, 4 hours around another major city, where the Port of Houston is 45 minutes to downtown. So we are actually tracking that as industrial real estate in a whole is is growing, and the need is growing really rapidly. There's not a lot of land near the port, so land prices have doubled near the port, as well as lease rates have gone up. And now what's happening? Dallas is your number one industrial market in the country. Well, there's no more industrial. There's not enough permits, submissions to being built, kind of what Holmes said. So you're seeing this rapid shift, right? Where I think industrial is a very secure asset class in the last couple of years. Cap rates are low, meaning that sales prices are really high. We're currently selling units, but to go in a little deeper, we're building the smaller industrial plants and business parks. And what I mean by that is, if product, for one example, product or manufacturing on the smaller scale comes in through the port, and then they manufacture product and need to store it somewhere else. So we build on the outside of ports, for example, 45 minutes to 1 hour north of Houston, in smaller warehouses where business store product. If it's e-commerce, maybe they're selling on Amazon, delivering to houses. So we're tracking ports, industrial, as well as housing being built. So to add to Kevin, wherever there's big plants being built that they're going to create jobs. I agree with him, not data centers, right? Data centers are going to create construction jobs. They get built very quickly, actually. So I believe a lot of the construction is going to come from outside the area. People that are very familiar with building large, 1 to 2 million square feet. I think Meta is building a 3 million square foot plant. And it's very different to see. Mike, you coming from multifamily, you're targeting jobs, income, where the growth. We're still targeting that on the industrial side. We want to see manufacturer growing. Where are the big companies where jobs are created, as well as where are they building houses? Where are they building apartment complexes? Even though we're not competing with that, we're building the warehouses where small businesses either need to store product or operate out of, right? The HVAC companies, the plumbing companies, construction companies. And that is our customer. Their customer are the housing, the multifamily, the single family housing. So it's all data you have to track. And also, I believe Rebecca said it earlier, investors, I think, have been more conservative in the last couple of years. You had T-bills. I know multiple investors with a large amount of wealth. They had money in T-bills at like 5.9% with no risk. So even if you're offering 15%, I think for a while, people were just kind of waiting on the sideline to see what was going on. And now I think T-bills are 3.9 right now. Yeah. Now I'm having calls with investors going 3.9, inflation's at about 3%. They don't really like that spread. So now they're starting to say, all right, let's look at these alternative, because they weren't happy with maybe some of the multifamily, at least some of the conversation I've had. So people, I think, are being more diverse, right? They've got a little in the stock market. They've got a little in alternative. Maybe it's real estate. Maybe it's car washes. I feel the calls that I've had in the last 12 months compared to the last 3 years prior to that have completely changed. I think you've got a lot of new investors in the market. And then also, probably for you too, Mike, in the multifamily, there's a lot of bad news in the multifamily right now. Like investors losing a lot of money. People I know personally that have 16 deals and one is going very bad. And so it kind of makes our job a little bit harder. It's like, hey, how are you doing that? Even though I'm not in multifamily, I think it's being very clear, hey, what kind of deals in the past have you had go wrong? How did you handle it? So if you're an LP on this video, I've lost money, on a deal as an LP. and the communication was poor and it's frustrating. So I made sure, even though we haven't lost investor money in industrial, when we did in private lending, we communicated, we recovered from it. But how is that team, that general partnership, going to recover during hard times? So if you're an LP, I think you should ask the hard questions to any of us that are investing your money for you.
Yeah, I think that was great advice, Kurt. And I have a follow-up question, but I want to make a comment on what you said. Because industrial is going so well, right? Because of the need around AI and building these data centers and the blue collar workers you're going to need to be electricians and plumbers and bricklayers, right? Because of that need growing as a result of the data centers, you know, I think we're seeing more workforce housing needed, right? Which in turn means multifamily is going to make a comeback and it's going to cycle back. And I think it's just, there's no geniuses in the business. There's only market cycles. And where we're at in the cycle, if you can watch what's happening and you get involved in the beginning, I think you're going to do rather well. Even if you've lost, and I've lost money and I've lost investors' money, and it's a terrible thing, but it does happen. It's indicative of the market cycle. But I think where we're at right now is a very optimistic time. I talked about that deal that we underwrote at 15 million, and then the broker said, 2 years later we can buy it at 11. That's a big spread, right? And you're seeing deals like that come to the market today that are big opportunities. But here's what I wanted to ask you. Based on the strength of industrial, okay, and based on everything that you said, do you think that is indicative of the current administration? And not to get, I certainly don't want to get political here, but do you think it's indicative because of the current administration? And do you think that if the administration changes, from red to blue, is that momentum going to be lost?
I think that's a perfect question. And I think everybody wants to know that in a sense, right? Because yes, administrations change rules and how people invest. I think yes, industrial is growing, number one, because of the tariffs. So a lot of product, I know people that were ordering everything overseas, bringing steel, lumber, everything in is getting taxed, right, with the tariffs. So it's encouraging more manufacturing in the US, including car dealers, right, car manufacturers. So one thing would be, yes, I agree with that. The second part of that would be, with Trump's tax bill, with no tax on overtime, no tax on tips. You're seeing blue collar people want to work overtime, building the houses, building the industrial buildings, building multifamily. Right where I live, they're building a bunch of multifamily in California. In our housing supply, I think the last number I read was we're 7 million houses still short. And where's that going to come from? Well, that's going to come from the administration encouraging people to build. So lumber is still up. Concrete is up 30% in the last 2.5 years. Steel is up 10% in the last 18 months. These are numbers that you got to track because you have to encourage builders to go build it. Then you have to encourage employees to want to go, the blue collar to go work hard, right? And I think people only want to work hard right now if they're rewarded for it, So yeah, I do think it'll shift. I mean, if blue comes into office, and they say they backtrack on Trump's tax bills and they start taxing the overtime and you start taxing the tips. I mean, you're not encouraging people to go work and grow our industry or our economic state of the U.S., right?
Yeah, yeah. Hey, Rebecca, let me ask you this. If a client comes to you today and they have $200,000 that they want to invest somewhere, where are you pointing them in your world today?
Situation, obviously. If they're, we focus first on foundational safety. Assuming that my client is saying, hey, I have another $200,000 to deploy and all of our bases are checked. And we look at real estate as the thing that comes up often. The tax advisory office, the real estate advisory office at Blue Sky is very busy these
Yeah.
days. But we have a lot of people. Interesting, Kurt, that you mentioned Houston, because I just worked with a client in Houston who had gotten in and they just didn't vet the people they were in business with. They just didn't vet them well and made the news and all of it. So now we have a 67-year-old couple that had an extra 200,000 and now it's gone. So we work on really partnering with people if they're going to go real estate, and people are very interested, especially in Texas. Like you just can't. There's houses going up everywhere. I'm going to have to move further out to the country. There's so many people in Texas, but they're interested. They want to do that, especially if they have more. You know, they're coming into. I'm done working. I have more for my 401k. I don't need to spend it. What can I do? Real estate is a great option, and we definitely talk about that, but we really work with our folks strongly to vet their partners because there are not everybody's a good guy. And
Yeah.
so that vet as a fiduciary, I have to say we're gonna slow our roll. Yes, real estate is a great idea, but we need to make sure that what you're looking at, and people bring us stuff all the time, say, hey, let's vet this. Let's make sure. Okay, well, and to your point, not that you don't ever lose money. We're investors, of course. We're going to lose sometimes. I wish I could say that I guarantee you're never going to lose money, but I value my license, so I'm not going to say that.
Yeah.
Uh, but that vetting process, that fiduciary process, when I have people with extra, especially in Texas, real estate is a great place to go as an alternative, and a great place to deploy funds when we have extra. And there are lots of people now who followed all the rules, right? We get a good job, we save really well, and now here we are, and we have funds in 401ks and IRAs that we simply don't need. What are we going to do? How can we make sure if the stock market corrects, we're still good? So we have those conversations quite a bit.
Yeah. Yeah. Hey, I want to just make a comment on the tariffs, right? So the tariffs have been a good thing for the country, really. And I think that in the beginning everybody resisted it and there was pushback. But, obviously, he's a chess player and is 7 or 8 moves ahead of just creating those tariffs. I own another business where I bring product in from overseas from my business to be manufactured here. And, they've killed us. So, it's been good, but it hurts. The growth, and I think that that's the thing, that's something that investors need to think about is even though there's some pain along the way, the growth is productive and the growth makes things really come to light. Hey, Kevin. So this is really specific for you, but what's your argument against real estate, specifically real estate syndications, that you think most real estate investors don't want to hear?
My argument against, meaning why I would choose another asset class over real estate.
Over a real estate syndication.
Okay. Um, well, it depends on the individual, what they're looking for, and what that money's for, right? So, the way I approach things in the stock market is I'm a very thematic investor. So right now I'm heavily invested in technology during this transformation that I think is going on and going to continue to go on for another 5 years at least. But I always ask people, um, what's your time horizon and what's the money for? If you need this money in 2 years, then no, you shouldn't be in the stock market in these stocks. You should be much more passive. Just buy an index fund or a vanilla ETF. So I guess my thinking would be the same for anybody considering real estate. What kind of money is it? Is it 5 year money? Is it 20-year money? And so when do you need it? And then what's your risk tolerance? In many ways, the stock market is much riskier than multifamily overall. So I think with multifamily, and you guys know this and could explain it better than I, and I think some of you have touched on it, it's a lot about the operator. Do you know the operator well? What's their track record? Who are they partnered with? And that kind of due diligence gives you a trust factor and a confidence factor that, yeah, I can let them tie up my money for 5 years in a deal. So that's kind of the way I approach it.
Yeah. So I think we've been seeing a lot of investors sitting on the sidelines for the last 20 to 24 months, maybe even a little bit longer. Just, because maybe they got stung in a deal, maybe they heard about somebody that got hurt in a deal, but they're just sitting on the sidelines. So, Colin, I kind of want to start with you with this question, but why do you think today, after this period of time that we've been in, why do you think that some investors commit quickly and others just stay on the sidelines? What are you hearing? What are you seeing in, again, in that investor sentiment?
I mean, obviously, people buy emotionally and they justify it logically. Just going off of Kevin's point, I think one of the biggest mistakes right now is investors are thinking short term, and then you had this flurry of capital raisers that are celebrating raising capital when you should be focusing on how to manage the asset and make money during the hold. That's why people in this call right now are they're really more they think long term. How did the richest people in the world make money? Like Blackstone. They're thinking long term. But then the problem is you have these opportunities that are actually harder to raise for because the majority of retail investors think short term. So you have these general partners that are or these capital raisers that are they're not only are they feeling pinched like they have to get skinny on operating costs just to make the returns higher, they're and I this is a huge mistake. They're putting in time constraints related to the debt. I mean, one of the things everybody knows now, at least myself, the experienced people on this call already knew this, but like a rate cap doesn't do anything. The economy is not going to slingshot in those 2 to 3 years that a rate cap is in place. And when you need a rate cap, it's way too expensive. So people need to start thinking long term and don't invest in an opportunity that has a time constraint related to debt or business strategy because you need to give the operator wiggle room in case something happens. Like if we go into World War III, the last thing you want to be in is in a project that has some sort of debt due 1 year from now, and then the whole economy shifts. Like if something goes wrong, you want to have an investment opportunity that allows you to stay in it until it's right to sell. But just building off of what Kurt said, can I share my screen real quick?
Yeah, hang on one second.
Okay.
Let me.
Um, and then also there's a mention of taxes. There's a great book called Daylight Robbery, How Taxes Have Shaped Our Past and Our Future. I think every person needs to recognize another big mistake is the lack of cost connected to tax. You mentioned, so my lady calls me, hey baby, can you go pick up some milk at the grocery store? Well, I got to stop at the gas station. I pay tax. I'm on the road that I pay tax for. I'm leaving my house that I have property taxes on. I'm getting the milk that actually doesn't have tax. But let's say I grab a magazine on the World Cup. That's going to be taxed. There's all these taxes and they accumulate. People don't think about that. So the number one mistake investors make is not positioning themselves for better tax management. But Kurt talked about the prices of lumber. This is just a website called tradingeconomics.com. Check it out. It's got a lot of commodities. It's got key indicators. It's just a tool for investors. But one thing to point, he talked about it went up 10%. He's right. But look at that hurt for developers. And then the second thing is Kevin talked about high tech growth. This is a Milken Institute report, free report. You can download it. It's like 50 pages long. And it ranks all these different cities based on a city being larger than 250,000 and a city there's two divisions, big cities, little cities. And they base it based off of employment, wages, high-tech growth, high-tech concentration. So that's key for what Kevin's talking about, and economic opportunity. That's a 50-page report. It's just a resource for investors. I just wanted to share that.
Yeah, Milken report is really is something to look at least once a year for sure. Kurt, how about you? Same question. Why do some investors, who have been sitting on the sidelines continue to sit there and then others commit a little bit quicker?
Yeah, I think it comes down to risk tolerance and what they're comfortable with. Um, you know, if people, depending on what news channel they watch, but the news has been saying, hey, we're on the verge of stock reset for the last 2 years. And I think another point to that is with Jerome Powell being out and a new Fed chair, a lot of people were like waiting, well, what's this going to do, right? Are they going to lower rates? Because we all know Trump is in the news saying he wants lower rates. Let's stimulate the economy. But the Fed chair, which it might work out really well, where he's kind of in the middle. He's not really going to be Trump's puppet and do exactly what he says, even though he wants to lower rates. It sounds like he's going to keep them stable for the next 6 months. Now, I would like the rates to go down for my deals, my commercial loans, everything else. But overall, he has to control inflation, jobs, everything else. So I think that's a big indicator where if you start seeing the rates coming down gradually, 25 basis points a quarter, now I think you're going to see investors start investing more as refinance opportunities start going. I mean, we've been in a high rate environment for what, 3 years now, 3.5, something like that. It makes it hard to like pencil deals. We have raised investor capital, done permit plans and everything for development. Then all of a sudden the rates hike up a little bit. They're what, 90-day trailing kind of to an extent for actual development loans. So the rates hike up a little bit, and all of a sudden, you underwrote conservative at 8%. Now your bank is telling you 9%, and now the returns went from 20% for development. Now it's 14. Well, we actually canceled a deal during due diligence period, refunded investor money because for us it was just too much risk. So all of us are stewards of people's money. My company took a loss on that and they said, hey, we would rather return the money. And so it makes it challenging, right? I think if we see rate cuts come down, you'll start seeing people build more. It's going to encourage builders. I think even if I remember right, the large home builders, Toll Brothers and Lennar, they kind of slowed building down a little bit due to lumber, due to high rate environment. They kind of slowed it down. So I think we'll see some more economic growth if the Fed chair starts bringing down rates a little bit. But I think we have a little bit longer before that's going to happen. I personally thought we'd be lower than where we are now. I kind of hope for it, but also as a conservative underwriter, meaning I underwrite for the worst case scenario and we can't refi and all these things. I'm glad I do it that way. Where some operators kind of underwrite for exactly what it is now without forecasting for some issues. Those are the operators I think that are getting in a little bit of trouble. But yeah, overall, I think the interest rates are going to be a factor with investors feeling comfortable jumping in, taking more risk, whether it's in the market, the stock market, or the real estate, or any other alternative market. I think I would like to see some rates move. I mean, I put all my money in investments because that's what's going to grow my wealth. I have a different risk tolerance. I'm 44. I've got years to earn. But like my father or people in their 60s or 70s, they don't have that long and they don't want to risk it, right? They want to be real comfortable. And I can see that gap with the age difference, between a 30 or 40-year-old or a 60 or 70-year-old.
Yeah, well spoken. Thank you. All right, so I can't believe that we're almost at an hour here. So I want to at least start going to the direction to land the plane, right? So I think we have a number of investors listening in tonight that are here with us, and I want to kind of like from their perspective. And Kevin, I'm going to start with you, but from their perspective, what are some questions that a passive investor should ask before going into any deal, whether they're buying Intel or whether they're investing in an industrial project or a multifamily project? What are some questions that investors should be asking?
Well, I covered some of them before. I always make it really simple. What kind of money is this? So when you have money to invest, when I say what kind, when do you need it? Is it really part of your emergency fund, or is it money that you really want to grow for 5, 10, 20 years? And that's obviously a big difference to decide where you're gonna put your money and how long you're gonna tie it up for and what kind of risk you're gonna take. If you go into the stock market, you've got to deal with the volatility because the stock market moves on emotions and big extreme swings of investor optimism, investor pessimism, and then if you get a cycle or a recession. One thing that's neat though about the American economy and our capital markets is they're very quick to process information. So if you look at COVID, when the world shut down and it looked like we were going to be in a deep recession because everybody had to stay home and businesses were closing, what we actually got was like a flash recession. And so, yeah, the stock market, went down 30%, but smart investors saw the window out that this was going to turn very quickly. And so, you've got to be able to absorb those kinds of shocks. When the tariffs hit in April of 2025, we got a similar short-term shock, but the markets saw through it pretty quick. And so that was actually a buying opportunity. So, you know, passive, if people don't want that kind of volatility, then yeah, they just buy the triple Qs or a nice ETF that gives them that sort of passive sleep at night risk. You diversify across 20, 30, 50 companies, and then you can weather the storms. You have to know what kind of money it is, who you are, what makes you lose sleep at night. For myself and the investor group that I work with, I we do a lot of fundamental research every day, and so that's what gives us conviction. So we're actually prepared for instance in the stock market. If our favorite stock goes down 30%, we're like, wow, another great buying opportunity because we did the research, we did the homework, and then we have the conviction. So those are the kinds of things that I think people want to look at. I want to throw a couple of numbers at you that I think will round this discussion out. We've talked about the industrial renaissance and bringing U.S. manufacturing home. I'm looking at a website right now called Industrial Sage, industrialsage.com. Their investment tracker is looking at announced manufacturing investments since 2025 of 1.77 trillion. Wow. This is just a staggering number. It's across 162 companies and 37 states that they track. And 1.2 trillion of that is the data centers and the semiconductor foundries, the new factories. So that other, half a trillion is primarily in autos, but that's going to be in robotics too. And just today, for your headline, 250 billion, Micron just announced today that that their total investment for the next 10 years in U.S. Manufacturing is going to be 250 billion. So those are the kinds of numbers that I think can give investors vision about how long do they want to lock up their money for, whether it's in real estate or the stock market.
Yeah, thank you for that. I think that there's two theories in investing in real estate, right? There's that short-term 3, 5, 7 year theory, but then there's that long-term 15, 20 year theory. And I think that the market is driving more towards long term because, even if there's a problem, there's a correction over time. Time heals everything. Think about breaking up with, your spouse or your significant other. Time heals that hurt. Well, it's the same thing with real estate. It's over time. And I think the long-term thesis today makes more sense than the short-term thesis for investors. But Rebecca, how about you? What are some questions investors should be asking before investing, either traditionally or alternatively?
We do it is we allocate first towards purpose money. Let's make sure our lifestyle is protected. Assuming that's done, then we approach investments from first and foremost, what are we going to allocate? What assumptions are being made in the investment, right? So what's the risk, who's managing the investment, and what's their track record, all of those things, and not just their last deal. Like, people come to me, this person just did this thing and now we're gonna, allocate 40% of our portfolio. No, 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 we're not gonna do that. So assuming all of those things, due diligence is a big deal. Looking at the person managing the investment, and then really, to your point, Bert, looking at worst case scenario. Okay, so let's just assume for a second. Let's play this deal out and it all goes south. How are we feeling? Are we still okay? Are we good? We're gonna hope it all goes exactly the way everybody thinks it's gonna go, but let's think about things from the other way so that we don't have to go through that time of recovery, and time makes all things better. Okay, well, let's consider the worst case scenario now so that we're prepared. Hopefully, but hope and pray is not a financial strategy. We can't just hope everything goes well and pray that nothing goes wrong. That's not a solid strategy, right? So we need to consider those things first, and those are the roads we walk down with consumers today.
Yeah, true, very true. All right, last question, everybody. And I want everybody to think about this. But if somebody came to you today, and maybe it was one of your kids came to you today and said, "Hey, I have $100,000 that I want to invest," and I don't want. Here's the answer I don't want. I don't want somebody to say it depends, right? It depends on what you're looking. I want a real gut answer. If somebody came to you today and said I had $100,000 to invest, where should I invest it? Colin, why don't we start with you?
All right, I'm gonna flip it on you. You got $100,000 and you double your money in, let's call it 5 years. Okay. And you spend about 20 hours of reading investor reports, so that's what, $5,000 an hour you're potentially earning yourself. So I'm going to tell you, hey, you have an opportunity to earn $5,000 an hour with the passive investment, but you need to do a little bit of research yourself. So the first thing, and Rebecca talked about this, and I call it the war chest. So you need to have a war chest, which is X amount of months, a runway that you feel comfortable off. It's your play money. And then the second thing is, and I brought these books out. These books, you got to do your homework. This is your family's legacy. These are my top books that I recommend. And so the first one's every real estate investor needs to know about cash flow by Frank G. This is a fantastic book. Mike's a popular guy. Second one is a hands-off investor, and then by Brian Burke. This is like, to me, this is a Bible of passive investing. And then in the back, there's 67 or 72 questions to ask a sponsor, which is what Kevin mentioned, right? So reach out. There's ways to get those questions, but this is great for getting a foundation on investing passively. Then Rob Beardsley has a book. It's all about debt and equity. That's what killed a lot of deals in the last 5 years. You need to understand that. It's a quick read. You can read it from California to Dallas. And then another one, which is basically the first book with case studies, same author, real heavy, very numbers heavy, but it's important because this is your livelihood. This is all about numbers. And the last one is just to kind of give you an idea of how to manage an asset. So you take that and then you think, okay, I have $100,000. How many projects do I want to put it in? Well, some of the more sophisticated investors will set up an entity with a few of their friends and they'll invest as a group. So they each put in maybe 100,000, let's call it a minimum of 100,000 across 4 investments. They have $400,000 in a pot. Instead of having $100,000 going into one investment, 25,000 of that project, or 25,000 of that 100,000 can go into a different project. So now you're diversified and you have less financial exposure per project because you put it in an entity with someone that you trust to evaluate the project with, but not someone you have to trust to execute on the project. Very different. So this is really, really common in South Asian families. Create an entity, invest as a family. More people put the money in. You can basically reduce your financial exposure per project. I would also tell them, and I'm not telling them where to invest yet. I would also say ask if you can invest below the minimum. And then I would say get involved in your local meetup communities. And then I would say, have calls, set up calls, create a process for evaluating these opportunities so that you can reduce your headache and your heartache. If you don't have a process, how can you be consistent in your decision making? And when you're not consistent, you start letting emotions get involved. And that's when you make a silly decision and you invest with something that is exciting versus something that makes sense. So I didn't really answer your question, but I want to prep investors for making a prudent decision versus investing, because don't force an investment.
Yeah.
I could talk more, but I think these others have some good insight.
Thanks. Appreciate it, Colin. How about you, Kurt?
Since Colm, I think you did a great job. I'll go straight for the investment side. My advice would be to diversify a little bit. I would call a Rebecca or a Kevin and throw 25% at tech. Personally, I think we got a 10-year run on that. Some of that will be high risk, so I wouldn't go all in 25 grand on one company. I'd probably go 5 grand, five different leading companies, and leave that in as kind of a long term, hopefully get that 1,000% return over 10 years or whatnot, right? I would take another, I'd probably go with like 50% for me. I would still advise the industrial market. It's hot, it's growing, the cap rates are good, it's secured. But depending on the age of the person that's investing, is it you're going to go buy and sell at a very high return, is what kind of we're doing, or they should buy some existing assets, industrial assets, and get a lot of the tax write-offs. Those are typical returns are like 14% a year, where development and sell is up in like the 20 to 25, almost 30% a year. So I would diversify some short term, make some money in a really good market, and then I would throw another like 25 in a longer term 10-year investment in the industrial side. So, because those are a little bit two different investments. So it's kind of like three different investments. You're diversified, you got some safety net, you got some higher risk, but overall that blended rate will probably be up in the 20-25%.
Yeah, I love the diversification aspect. Thank you. How about you, Rebecca?
I could say I had something to add, but Paul, that was a brilliant answer. If I can't say it depends, that was a brilliant,
Right?
right? I can't say it depends. That was brilliant because it really, depending on time frames, and then if you map on to investor education, Kurt, your idea of buckets, like I always tell investors, we can accomplish anything, but we need to know what we're accomplishing. What's the goal here? Is the goal 5 years? Is the goal 40 years? It's going to matter. So if you diversify across time frames, maybe we have something short with a higher rate of return, something that's going to get us there, but we're also looking down the road 10 years. We look at tech, we look at things like that, and maybe sprinkle some real estate assets and investments into that. I think that's the way to do it. So I don't have anything unique to add, but I think those were two brilliant answers. Really well done.
Thank you. Kevin?
Okay, so I don't know the investor. I don't know their goals. But they've got 100,000. I'm going to go all stock market, half of it in the triple Qs, the NASDAQ 100, because you're buying the top 100 companies in the US across technology, hardware, software, and even healthcare. And it will just outperform most things, including the S&P 500. Then the other half, I'm going to say, find an ETF that is oriented towards AI and robotics. Robotics is going to be a tremendous growth industry over the next 10 years. It'll really start to heat up in about 2 or 3 years. So Elon Musk, SpaceX, he wants to have Optimus humanoid robots in your home. His are going to be too expensive, but there's 300 other companies competing. And so robotics is going to be huge, not just the humanoid robots, but all autonomous machines. So I'm not going to tell you which ETF to buy. I have 3 or 4 AI and robotics ETFs that I look at. But do some homework, pick one, because what it will do is it'll make you look at the companies inside of it. And you'll start to study those companies and understand their businesses and why they're successful or not and how they're growing. And I'm all about education, and I love to learn about new technology all the time. And when you can combine learning about new technology and science with economics and making money, to me, it's a match made in heaven.
Yeah, awesome. Thank you. Yeah, I think that we all need to be students of education, right? And continue to learn. I think that as soon as we stop learning, I think that we stop growing. And, that education piece, to continue to educate yourself, whether it's on traditional investing, whether it's on alternative investment, industrial, multifamily, it doesn't matter. You have to keep learning, and then, build your trust, build your confidence, build that relationship with whoever that operator is. Or I like the perspective from how the families invest together, because you have more eyeballs looking at the problems a deal could have or the potential opportunity a deal could have, and making decisions together like that, not solely based on the operator, but based on the deal. So, hey, I want to thank everybody for being here today. I know we ran a little bit over, but I think it was well worth it. Great comments, great panel. I appreciate you guys. I appreciate the guests that have been hanging in there with us. We had a whole house full tonight, which was awesome. Real quick, if you guys want to give your contact information and throw it in the chat and say it out loud so people can reach out to you if they want to. Kevin, why don't you start?
Oh, where to find me? I was reading some of the chat. Is that where you're asking?
Yeah.
Other than my paid services at Zacks Investment Research, I have a free education group on School. Raise your hand if you've heard of School, SKOOL. It is hands down the best social community place. Like you can build a private community. I'm the captain of the ship. I make all the rules, and everybody's nice to each other, and we don't talk politics. All we do all day long is share research about stocks, companies, industries, tech and technologies, and where this is all going. I'm like posting on there 12 hours a day, and my people love it. And then we learn how to pick stocks from that too. So my community is called AI Stock Investing. So you can look up me, Kevin Cook. If you just go to School and put in the keyword investing among free communities, I'll show up at the top, AI Stock Investing. It shows a robot pointing like this.
How about you, Rebecca?
Yeah, financially, you can reach us at blueskyfinancial.com, socials, Instagram, Facebook, LinkedIn. I don't TikTok. I guess I'm too old for TikTok. I think I don't TikTok.
Nah, you're never too
Everything
old.
else, though.
Never too old for TikTok.
My learning has not expanded to TikTok. I love to learn too, but I have not gotten to TikTok yet.
Colin?
I just put my email and my LinkedIn in the chat, and also my name right there.
Awesome. And Kurt?
Yeah, threw mine in the chat. CaptainCapital.com is my website. I do a bunch on YouTube, just touring industrial, how the developments work, how investing with us work. I just put out a video last week from an open house, and some potential investors as well as current investors gave some testimonials. It was great. So do a lot on YouTube, but yeah, website's up there, and hope I learned a bunch. So look forward to connecting with Kevin, and I diversify myself. I'm pretty all in on the real estate. That's what I do day to day, but I like talking to experts like Kevin and Rebecca for my future planning, right? I am all in on real estate. I know a little about tech, but I still go to the experts for that for my own family's money. So highly suggest diversifying as well.
Awesome. And anybody who wants to reach out to me, if I can have a conversation with you and help you in any way, you can find me on Instagram. Pick your phone up and follow me on Instagram, because we are always bringing great content and great people that we do podcasts or webinars with. Or you can reach out to me directly. I love to network and just have those conversations. And I want to thank all you guys again tonight for being here. Rebecca, Colin, Kurt, Kevin, thank you. And we will look forward to talking to everybody soon.